Hi everyone, this is Bill Cantor with Cantor Wealth Management. I'm a financial planner in Skokie, Illinois. I'm also the author of the book, Your Best Retirement Plan, How to Eliminate Market Risk, Avoid Taxes, and Have Money for the Rest of Your Life. And today we're going to discuss the tax-free plan and why the tax-free plan, which is the subject of my book, is the ideal investment. So first, let's discuss some of the features of the ideal investment. Ideal investment would be entirely safe from loss, would have great returns, entirely tax-free, not just tax-deferred like a 401k or IRA, great liquidity, low fees, and would pay out immediately 2 to 20 times your money if you died suddenly during the plan, whether you're in the first day or first month or 10 years later, you'd get a large death benefit tax-free payout to your heirs. Let's compare the typical investment account, like a stock, bond, mutual fund account, perhaps your IRA or 401k is in that kind of account, with the tax-free plan, which again is the subject of my book, Your Best Retirement Plan. So the typical investment account, is it safe from loss? No. Market goes up and down all the time. Great return, sometimes the market goes up and sometimes it goes down, so it may have great return sometimes. It's not entirely tax-free at all. It's taxable either as you earn the money, or if it's an IRA or 401k, you take out the money, you pay tax. There may be great liquidity depending on if the market's up or down. If the market's down 20, 30%, you may not want to take your money out. The fees are not low, as I will show you. The fees in a typical account are pretty high. And, of course, there's no immediate death benefit. If you die, you only have the money in your account. You don't have any extra death benefit paid out to you. On the other hand, the tax-free plan has all these. It's safe from loss by guarantee. Guaranteed safe from loss, you don't lose. Great returns, as I will show you. Entirely tax-free by IRS rule. Great liquidity, low fees, and it has an immediate death benefit. It pays out 2 to 20 times your money if you die suddenly. So the tax-free plan, in other words, is a high returns, low risk, and tax-free plan. Tax-free plan is the ideal investment. And to prove that, I'm going to compare the tax-free plan on the left-hand side here with the typical stock market or investment account over here. And the assumption we're going to use for this comparison, we're going to assume a person aged 50 years old who puts $100,000 into each plan. In the tax-free plan, the annual growth rate, we're going to assume 7% because the tax-free plan uses a 0% floor, 13% cap strategy. That means the worst you'll do in any year is earn 0. The most you'll earn in any year is 13%. So you don't lose, but the most you'll earn is 13. The annual growth rate in the stock account is going to be 7%. We're going to show why we're using this assumption, but that's 7% average annual growth rate. Tax-free plan has 0 taxes, so there'll be no taxes taken out by law, by IRS rule, 0 taxes. In the investment account, we're going to assume a taxable rate of 20%. The annual fees in the tax-free plan, we're going to copy directly from the tax-free plan expense report, the written report that's given to everybody who's in the tax-free plan. We're going to copy it directly from the written report. The fees in the investment account, we're going to assume is 2%. So let's first explain these assumptions, why I'm using these numbers. So this is the stock market from 1997 to about currently. You see there's a lot of ups and a lot of downs. So it's very good if you get in at the bottom. It's very bad if you get in at the top and you lose a lot of money. What I ask my clients is, could this happen in the years right before or during your retirement? This crash, 57%, 49%. Could this happen to you? In my book, I talk about Fred, who wanted to retire here. He wanted to retire in 2010 and wasn't able to because he lost his money, half his money he lost, and he took all his money out of his accounts, and he couldn't retire, and he was still working. So we're going to assume 7%, even though there's a lot of ups and a lot of downs. In the tax-free plan, we're going to assume 7%. This is the average rate of return over 5, 10, 20, 25, 30, and 40-year periods in the tax-free plan. Again, the tax-free plan uses a 0% floor and a 13% cap, so the worst you'll do is 0. The worst you'll get credited to your account any year is 0. The most you'll earn is 13%. So it's guaranteed you'll never lose any money. And see that the 5-year average is 9.7, the 10 is 7.8, 20 is 7.6, 25, 30, and 40-year is 8%. We're going to assume a 7%, which is on the conservative side. Of course, past results are no guarantee of future performance. In terms of taxes, of course, the tax-free plan has no taxes. Typical account has taxes somewhere. Most people are in the 22 to 24% tax rate. If you're $38 to $82,000 or $77 to $315,000, if you're married, you have somewhere that's 22, 24% tax rate, plus there's state taxes in Illinois where I am, it's 4.95%. So we're going to assume a 20% tax rate in the typical in the brokerage account, your taxes are probably going to be higher, but that's what we're going to assume for this comparison. As far as fees and expenses, so Forbes magazine in 2011 did a article called "The Real Cost of Owning a Mutual Fund," and they said by the time you get finished with the annual expense ratio, paying for the annual assets under management fee, and paying the annual trading expenses, a typical cost and fees of a brokerage account or stock market account is 3.57%. So we're not going to use 3.57% for this comparison. As we said, we will use an annual brokerage fee of 2% and an average annual rate of return of 7% and a 20% tax rate. Just bear in mind that your fee is probably higher. 7% is usually a risky number because you may have some losses, and your 20% tax is probably higher also. Okay, so let's get into the comparison. You see here this is a tax-free plan versus an investment account for maximum income. We're going to show this two ways. One is maximum income at age 65 for life, and the other one, after we do this, we'll see it just not taking on any income, just for growth in the account. So you see on the right-hand side here is the investment account, $100,000 at 7%. You're paying your fees of 2%, your taxes of 20%, and this is the total fees and taxes. This red numbers over here, total fees and taxes. Okay, on the left-hand side here, you see the tax-free plan earning 7% at 0% floor, 13% cap, $100,000 going in. But you'll notice that the $100,000 goes in over time, over 5 years, 2020, 2020, 2020. That's how you're putting your money into the policy, into the plan. That's because the tax-free plan is insurance-based, and IRS has rules as to how quickly you can put in the money into an insurance policy. You have to put it in over time. Usually 5 years is the most efficient way of putting it in. That policy, the $100,000 buys you not only the cash account, which we're going to show you, but this death benefit. So that's your immediate death benefit. As soon as you put this $20,000 in, you have $346,000 of permanent life insurance, and that $446,000 life insurance continues on until you start taking money out of your policy. These red numbers on the right here, these are your costs in the policy. There's three costs in the policy: premium load, cost of insurance, and expenses. And this is the total fees and costs. These are taken right from the policy expense report. So what I did was I ran the tax-free plan for maximum income at age 65, and the maximum income for life at age 65 is tax-free income you're taking out. Tax-free income is $14,628. So then I put $14,628 in the investment account and see how long that would last. You see, if you go to the next page, starting at age 75 over here, it continues, you see that the tax-free plan continues $14,628 of income for life. I ran it to age 100, but it goes for life. Whereas your investment account is out of money here at age 77. And here you're out of money, you have no more money left. Not only are you out of money, but look at the extra fees and taxes you paid. You paid $110,000 in your brokerage account, your stock account. You paid $74,000 in your tax-free plan account. And again, a lot of that money went to buy this insurance. So you see that all this income just from age 78, when you ran out to age 90, if you go down here, the tax-free plan benefit by age 90 gives you $190,000 more income. That's these years of income. It has $119,000 still of insurance that will pay out when you die. And then your fees and taxes by age 77, when you ran out of money over here, was $36,000 more money that you paid in your brokerage account. That's a total tax-free plan benefit of $346,000 on your $100,000 investment. And remember, all that is with no market risk. Okay? $346,000 a benefit and no market risk, and all tax-free. Let's just take the same thing for maximum growth. So you see I'm doing the same thing, but I'm not taking any income out of either account. I'm just letting the account grow. Also, if you look at the right here, this investment account, the taxes are 20%, but in this case, I'm not taking the money out of the investment account. See down here, this asterisk? The taxes are shown, but not deducted from the account. You're going to pay your taxes not from this investment account. You're going to pay it from somewhere. You got to pay it from somewhere, but you're going to pay it from somewhere else. So you see that after 11 years in the policy, at age 60, your cash value in your tax-free plan is $121, and your cash value take out after paying expenses and taxes from another source, but you're paying the taxes in your investment account is $148. So you're still have more money in your investment account, but look at the fees: $49,000 in fees and taxes in the investment account, $39,000 in the tax-free plan. By age 70, you have more money in the tax-free plan, $233,000 versus $219, and you have double the fees. You have $123,000 in fees in the brokerage account, $64,000 of fees in the tax-free plan. If you go to the next page and continue on, by age 80, it's $458,000 versus $332,000, so that's about another $125,000 of money in the tax-free plan, plus $481,000 of life insurance, and your fees are $240,000 in the investment account versus only $87,000 in the brokerage in the tax-free plan. And look at the cost of insurance. This $788 is the total cost of insurance to maintain this $481,000 of insurance. By age 90, it's $902,000 of cash versus $511,000, and a whopping $290,000 more of fees you paid in the investment account, $426 versus $136. So by age 90, $390,000 more cash, $45,000 of insurance because they pay this $947 in addition to the $902. They give you another $45,000 to make up the insurance benefit if you died here at age 90. And fees and taxes were $290,000 more. That's a total tax-free plan benefit of $725,000 over the 40 years to age 90 on your $100,000. Remember, again, all of that is with no market risk and no taxes. So what is a tax-free plan? So the tax-free plan is a special kind of life insurance policy that is high cash value, low death benefit life insurance. It is called Indexed Universal Life Insurance, or IUL. With IUL, we purchase a small amount of life insurance, so the policy qualifies as being tax-free according to IRS rules. That's Section 7702. Where insurance is tax-free, and the rest of your premium dollar goes into the tax-free cash value. So notice I said we buy a small amount of life insurance, right? Small amount of life insurance. Because we purchase only a small amount of life insurance, the costs and fees in the policy are much lower than a typical insurance policy, and therefore more money can go to the policy cash value, which is tax-free. See, normally life insurance is an inefficient and costly way of building up cash in a policy because you have insurance costs. Well, Indexed Universal Life buys a small amount of insurance, and the rest of the money goes to the cash value. So you're not paying too much in insurance costs. So IUL has more income, more growth, no market loss, less fees, no taxes, plus a tax-free death benefit from day one. So my question at this point is, would you like to see what your numbers look like? You may have different assumptions of taxes and fees and earnings that you may want to look at. And you may not be 50 years old. Like this person that I ran the policy on, cost of insurance is different depending if you're older or younger. So if you'd like to see what your numbers look like, please contact me. My number is 847-674-6470, or email me at bill@cantorwm.com. Thanks.